Will the stock market crash soon? This is something I've been hearing since really kind of the beginning of the year, which kind of makes sense. You know that, sort of early February, we saw a lot of volatility and the market still seems to be kind of in this large range. And the question keeps coming up, is the bull market over? Is the market going to crash? And I've been seeing this stuff online and various questions from people and just, various observations on Twitter and some different places. But what I've noticed is that stock market crash, that sort of term really means something different to everyone. So in this week's episode of Liquid Options, I want to talk about what a stock market crash means, or maybe what it means for you. And then I got some really cool stats I'm going to share that might give you guys, some of the bears out there might give you a little bit something to smile about. So you'd be interested in these stats. So real quick, one of the things, did you know that so far in this year, 2018, the SPX has had one of the top 20 worst one-day sell-offs since 1950. So we're going to take a look at those one-day crash stats and what that meant for the market on those other years, for the ones that were even worse. And then we're also going to dive into the current market and kind of what I'm looking at for this week. So again, welcome to this week's edition of Liquid Options. This is a weekly trading show about options in the stock market. My name is Eric. I hope you'll join me every Wednesday night here for a new episode right here on YouTube. There is one exception. Next week, I'll be traveling out of the country on vacation, so there will be no episode next Wednesday, but I'll definitely pick it back up the following week. So if you haven't done so already, be sure to subscribe to the channel and click that little bell to get the reminder for the next episode in a couple weeks. And our stock market crash discussion with cool market stats is coming right up. So as I mentioned, stock market crash means different things to different people. And that's the question I want to ask you guys before we get into the definition here and what I think it is. I really like to hear what you think it is. So in the comments of the video, if you'll put what a stock market crash means to you, is it like a one-day sell-off? Is a crash like, a 1 year sell-off, 1 month? Maybe you sell off 20% in a week. I'd love to hear what your opinion is of what a stock market crash is. But let's just go to the sort of Wikipedia definition. I'm just going to read this through it. I'll do it quickly. A stock market crash is a sudden dramatic decline of stock prices across a significant cross-section of the stock market. So we trade the SPY, it's kind of the whole thing, it makes sense, resulting in significant loss of paper wealth. Crashes are driven by panic as much as by economic factors. They often follow speculative stock market bubbles. I'm not going to read the whole thing, but they're caused by social phenomena, economic events, crowd behavior, psychology. Sometimes there's margin and things, leverage that have to get sorted out. Other aspects such as wars, large corporation hacks, changes in federal laws and regulations, and natural disasters of highly economically productive areas may also influence a significant decline in the NYSE. But ultimately, you get down to this. There is no numerically specific definition of a stock market crash. So again, put in the comments what you think it is, but the term commonly applies to steep double-digit percentage losses in a stock market index over a period of several days. And I'm in agreement with that. I think if the market sells off, 4, 10, maybe 15% within a week or two, I kind of think that's a crash. Crashes are often distinguished from bear markets by panic selling and abrupt, dramatic price decline. So bear markets are periods of declining stock market prices that are measured in months or years. So even though there's no specific definition, the crisis of the last financial crisis, we sold off 50%. The market got cut in half 2 years in a row, 50%. So that's more of a bear market, a longer time frame. But still, I'm interested to hear what you guys think about what a stock market crash is. So next, let's take a look at some stats. Let me bring them up. So this chart I came across online from someone I follow on Twitter. And what this person did was they arranged the years since 1950 by the worst single day return. And you can see the worst one-day return. And this is on the SPX. And so real quick disclaimer. As of all of the videos that you see here, these are for educational purposes only. This information was pulled from Yahoo Finance that this person told me. So again, I'm going off some information that someone else put together, but some of the stuff I've looked at, the numbers look pretty accurate, if pretty close as well. We're going to be looking at some Thinkorswim numbers, so there's some ever so slight differences in these percentages, but for the most part, I think this is relatively close to what I'm seeing in Thinkorswim. So just a quick kind of disclaimer there. So again, the worst one-day return. So the worst one-day return since 1950 was minus 20%. That was 1987. I think that was the the Black Monday. And gosh, I wasn't. I was a little younger then, so I may not remember that one. But anyway, so in this particular year, there was a 20% down day, just one day. And then the biggest drawdown from any high during the year was 35%. So what this person kind of just, put these random numbers together, that with these one day kind of big losses for the year, what these sort of pullbacks are for. So since we're talking about, crashes and things, and we talk about short term, but then we actually had some pretty big drawdowns depending on whichever year. So you see some various years here. So what caught my attention was 2018, this year, when I'm doing this video, we had just about a 4%, over a 4% down day. And we'll look at this on the chart here in a minute. And so far this year, we've actually had almost a 12% decline from the high. So that's kind of what that looks like. So let's go ahead and flip over to Thinkorswim and just look at that, right? So here is, the beginning of the year marks this area. This is the 200-day moving average, and we're going to talk kind of the importance about that in a minute. But I'm going to zoom in here, and first of all, the biggest decline was from February 2nd to the close of February 5th. And if I kind of mark this in here, you can see that was about a 4% decline. And like I said, the numbers are slightly different, but that was the big 4% in one day decline. So it closed here, opened up, sold off, closed 4%. If you actually go to the low of the day, you get a little bit more. So, but again, that was the big 4-day decline. Now, from the high of the year to the sort of low, or this sort of pullback here, was actually just over 11, almost 12% pullback, and that's pretty much what we're seeing in this chart. So again, the biggest one-day decline here was 4%, and we've had almost 12% pullback. So if we kind of go up here, this is kind of interesting. So in 2002, we also had a 4% decline, and the stock market ultimately ended up with a 50% pullback, which is pretty crazy. And in 1986, which preceded 1987, there was a 50% pullback, and then another huge return, and then you had the 35% decline there. So that was a couple bad years. I'm glad I wasn't trading then. But so the financial crisis, let's kind of find those. So you have 2008. One of the days in 2008 ended up being a 9% decline, ended up being a 53% pullback for the year. And then 2009, there was another 5% decline. I'm sorry, 5%, and then a 57%. I'd want to go back and check those numbers, but these are pretty big declines. So the question is, does this matter? Do these stats even matter? It may not, but it's one of those things that you just need to be prepared that this is a pretty big decline, a 4% in one day. The fact that I think this is 16th, the 16th biggest decline, one day decline in almost 70 years, something like that. I think that's significant. Now, could we end up with just being down 12% and we march new highs? Absolutely, just like we did in 1986. We were down 5%, 4.8%, and then we had a 10% pullback. And then the next year it got really ugly, didn't it, from 86 to 87. So, we could rally into 2019, and maybe 2019 we get a bigger pullback. So I'm not going to make any, predictions about what's going to happen, but here's how I'm handling this. And let's go back to the SPX. And I just want to re-emphasize the importance of this 200-day moving average. You can see the current market here. We're bouncing off this. We made some new highs. or at least broke this midterm high. My credit spread trading plan that's on the front of the YouTube channel, I talk about I'm expecting a large range, which so far has proven to be correct. But we're only a couple months in, so anything can happen. But I really encourage you to go back to the last two videos I posted. This is episode 6 of Liquid Options. Go check out episode 4 and 5, where I talk about the significance of the 200-day moving average and really just continuing to do bullish strategies until that's broken. Once that's broken, all bets are off. On the bull side, you can still trade short term, but if you're going to trade 30, 45, 30, 45, 60-day spreads, and you're trading below the 200-day moving average, I really think that's a little bit risky depending on, just holding it that long. Because if you do get one of those 20% pullbacks and you've sold put spreads way down here below, you could be in for some pain. So it's all about risk, and we're not going to talk about that in this video. But I just wanted to kind of show you these stats, and there's really, from my perspective, there's nothing to do about these stats we just saw. It's just sort of some information that's there. I continue to look at the 200-day moving average, and as long as we stay above that, I'm comfortable doing, selling put spreads. As the volatility spikes, it's easier to make a little money doing that. But again, as we lose the 200, or if we lose the 200 for significant, not just one day a little down, but if we really start to make new lows, at that point, you really got to be careful, or we could end up next year with one of these larger drawdowns, and maybe even this year. This year's not over, but this is the biggest one-day drawdown for this year, about 4%, and we've had about a 12% pullback. Now, what could happen, and back to the kind of big range theory, if we rally up to the top here, we could have another 12% pullback, right? Or maybe 13%, where if we rally up to, let's say, 2,900 and we come all the way back down, we're going to have another bigger pullback. So just because we say, there's a 20% pullback, well, if you're up here at 3,000, a 20% pullback, it's just going to be in this range here. So we're not really predicting any levels, but we did get the 12% pullback so far. And if we rally from here, then, maybe we could get another one. So I continue to sort of use the 200-day moving average as my kind of internal compass for staying relatively bullish. And if we lose that, obviously we switch strategy. So again, I'd love to hear your comments about any of the information you saw here, especially what you think a market crash is. And I'd love to hear the predictions, because I love seeing what people predict, and there's usually a little bit of a bear in it. So please put that in the comment section. Again, I'm going to be hanging out in the comment section the next couple of days, and then I'm going on vacation. So I'll be back in 2 weeks with another episode of Liquid Options here on YouTube, and I'll talk to you then. Thanks.